Hello and welcome to the Friday market update. So happy Valentine's Day. Don't forget to give your loved ones a big hug and a kiss. So now let's talk about mortgage rates because just like love, they can be unpredictable. So last week, I predicted rates would drop below 7%, and they did, but for the wrong reason. We were expecting a favorable CPI inflation report, which should have helped rates, but the numbers came in way hotter than expected, catching virtually everyone off guard. So that bad news sent rates soaring above 7% again. But then the very next day, the PPI inflation report, which tracks wholesale prices, came in much lower than expected. So that calmed the markets down a little bit and it came back from where it was. It was just kind of a rebound back and forth. And then today on Valentine's Day, retail sales data came out and it was a big miss. That was the push we needed to get the rates back below 7%, which is good. So what's going on? Well, the consumer spending is slowing down. One major reason, credit card debt is at an all-time high. We've talked about it before, 1.2 trillion and counting. So people aren't spending like they used to. Instead of shopping for clothes, shoes, and handbags, they're paying off high interest rate credit cards, and that's what they're spending their money on. And I think it's going to take away from the retail sales going forward. So when consumers stop spending, the economy just slows down, which can help drive interest rates lower. Will this trend continue? That's the big question. So another factor that is making Wall Street nervous, the Trump tariff talk. You guys have all heard about it. So raising tariffs could push inflation higher because importing countries may raise prices to cover the extra costs. But Trump's goal isn't to tank the economy. Do you think he wants to tank the economy and have rising inflation? That's what he ran on. It's to make the U.S. goods more competitive and bring more jobs back home. So it is a high stakes game, and Wall Street is hedging its bets. So they're not going to go all in on this until they really see the trend. So we'll need time to see how it all plays out. So let's talk a little bit about the real estate market. What do buyers want? Here's what we do know. Builders are winning the game right now. Why? Because buyers aren't worried about high home prices. They're focused so much more on monthly payments. Builders understand this. They're offering huge incentives to buy down mortgage rates and make payments more affordable. So what's the solution for listing agents? Sell like the builders. So here's the big question for listing agents. Would your seller take 99% of their asking price today? I'm guessing they probably would. And if the answer is yes, you must check out our Sell Like the Builders program. This program helps you compete with builders by offering below market mortgage rates on your listings. So let's take a 2-1 buy down as an example. Year one, the buyer's interest rate is 2% below the market rate. Year number two, the rate is 1% lower than the market rate. And then year number three, the loan locks in at the original rate as of today. So normally the seller would pay 2% of the purchase price to offer this incentive, but we cover half the cost for you, bringing it down to just 1% for the seller. And here's the best part. The seller only pays this if they get a full price offer. So if your seller would accept 99% of their asking price, then at a minimum, your listing should be marketing a 2-1 buy down. So if you want the details and the MLS compliant broker remarks to promote a below market rate and payment, text me directly and I'll send it to you right away. So let's keep winning. Hope you have a great weekend. We'll talk to you soon. Gaylord out. Bye-bye.